It's time now for a look at the day's top business news, and for that I'm joined by Yuka Roy in the studio. Yuka, we're starting in Sri Lanka, where the cabinet has resigned over ongoing unrest stemming from a deepening economic crisis there. Can you tell us more?
Well, Haxi, at the heart of this crisis is a severe shortage of foreign currency reserves, which has made it impossible for the government to pay for imports of fuel and other essentials. Now, hours of power cuts have become common as ordinary people are also dealing with shortages and soaring inflation. The COVID-19 pandemic hammered Sri Lanka's economy, especially the lucrative tourism sector. Deep tax cuts promised by President Rajapaksa during an election campaign before COVID also played a big role in the crisis. According to the International Monetary Fund, Sri Lanka's economy was set for a modest post-pandemic recovery of 3% this year, but consumer prices were rising at double the rate, at over 6.3%. Now, critics point to decades of economic mismanagement by successive governments. Sri Lanka has been borrowing a lot, with public debt standing at 119% of GDP. And the state has been spending more than it earns, with fiscal deficits exceeding 10% of GDP. Now, when the pandemic brought tourism to a standstill and sapped foreign workers' remittances, credit ratings agencies downgraded Sri Lanka, which made it difficult to access international capital markets. Now, the government is set to begin talks with the IMF for emergency loans and has also turned to India and China for help. But it's facing tight deadlines this year. As of February, Sri Lanka had just over $2 billion in foreign currency reserves, but more than $12 billion in total foreign debt. $4 billion of repayments are due this year, including a $1 billion sovereign bond maturing in July. Now, trading on the Colombo Stock Exchange was suspended for half an hour this Monday after shares plunged more than 5%, or close to 6% rather. Asian shares, meanwhile, made cautious gains this Monday after European Council President Charles Michel warned on Sunday that more sanctions were coming against Russia. Tokyo's Nikkei pretty flat as the stock exchange overhauled its market structure starting this Monday. Mainland China's markets are closed for a public holiday, but Hong Kong shares, as you can see, rallying up up more than 1.75 percentage points. Rising prices have been gripping consumers and producers across the world, caused by a combination of pandemic-led supply disruptions and the war in Ukraine. Millions of people are at risk of facing hunger in vulnerable countries. Niger, which is already struggling with a precarious food situation, could face its worst crisis in a decade. Our correspondents Harold Girol and Lucas Philippe have sent us this report.
This rice field is almost empty this morning. The soaring price of fertilizer is choking Niger's farming economy. A bag of urea, which is the most common fertilizer in Niger, was sold for €18 last year. It now costs €34, almost twice as much.
Because of the price of fertilizer, I can't employ more people on this field. There should be a lot of people on the field, but all the money is used to buy the fertilizer. Otherwise, at least 6 people should work, not just 2.
Russian gas is one of the main components of this very fertilizer. As a direct consequence of the war in Ukraine, prices have risen even further, by 30% on top of the previous price increases. Niger's farming sector had already been weakened by a drought and by the lack of security in the country. The government recently decided to reduce taxes on basic products like millet, which remains 17% more expensive than last year.
Taxes are not what make millet, sorghum or corn expensive. Lowering them is not going to change anything, because we grow them in our country.
In 2021, the crop yield was 39% lower than the average of the last 5 years. Niger could now be facing its worst food crisis in a decade, with more than 3.5 million people at risk of suffering shortages.
That report was the last in the business segment, and back to you, Haxi, now.
Thank you very much, Yuka.